Welcome to the chapter on portfolio management. In this chapter, we will cover the concepts of diversification, asset allocation, and performance measurement, which are crucial for effective portfolio management. Diversification is a risk management strategy that involves mixing a wide variety of investments within a portfolio. The rationale behind this technique is that a diversified portfolio will, on average, yield higher returns and pose a lower risk than any individual investment within the portfolio. The primary goal of diversification is to reduce the risk of the portfolio. By investing in a variety of assets, the overall risk is spread out. If one investment performs poorly, the other investments may perform well, balancing out the overall performance of the portfolio. Consider an investor who has $100,000 to invest. Instead of putting all the money into a single stock, the investor decides to spread the investment across different asset classes: $40,000 in stocks, $30,000 in bonds, $20,000 in real estate, and $10,000 in commodities. This way, if the stock market performs poorly, the losses might be offset by gains in bonds, real estate, or commodities. Asset allocation involves dividing an investment portfolio among different asset categories, such as stocks, bonds, and cash. The process of determining which mix of assets to hold in your portfolio is a very personal one. The asset allocation that works best at any given stage in your life will depend largely on your time horizon and your ability to tolerate risk. Several factors influence asset allocation. These include your risk tolerance, which is your ability and willingness to lose some or all of your original investment in exchange for greater potential returns. Your time horizon, which is the expected number of months, years, or decades you will be investing to achieve a particular financial goal. And your financial goals, such as saving for retirement, a child's education, or buying a home. A young investor with a high risk tolerance and a long time horizon might have an aggressive asset allocation, such as 70% in stocks, 20% in bonds, and 10% in cash. On the other hand, an older investor nearing retirement might prefer a conservative asset allocation, such as 30% in stocks, 50% in bonds, and 20% in cash. Performance measurement is the process of evaluating the returns of a portfolio. It involves comparing the portfolio's returns to a benchmark or standard to determine how well the portfolio is performing. Key metrics for performance measurement include return on investment, or ROI, which measures the gain or loss generated on an investment relative to the amount of money invested. The Sharpe Ratio, which measures the performance of an investment compared to a risk-free asset after adjusting for its risk, and Alpha, which measures the performance of an investment relative to a market index or benchmark. Return on investment, or ROI, is calculated using the formula: ROI equals the current value of the investment minus the cost of the investment, divided by the cost of the investment. This metric helps investors understand the profitability of their investments. The Sharpe Ratio is calculated using the formula: Sharpe Ratio equals the portfolio return minus the risk-free rate, divided by the standard deviation of the portfolio return. This metric helps investors understand the risk-adjusted return of their investments. Alpha measures the performance of an investment relative to a market index or benchmark. A positive alpha indicates outperformance, while a negative alpha indicates underperformance. This metric helps investors understand how well their investments are doing compared to the market. Assume an investor's portfolio has returned 10% over the past year. The risk-free rate is 2%, and the standard deviation of the portfolio's returns is 8%. The Sharpe Ratio would be calculated as Sharpe Ratio equals 0.10 minus 0.02 divided by 0.08, which equals 1. A Sharpe Ratio of 1 indicates that the portfolio's returns are one standard deviation above the risk-free rate, adjusted for risk. By understanding and applying these principles of diversification, asset allocation, and performance measurement, investors can better manage their portfolios to achieve their financial goals while managing risk effectively. Thank you for watching.